Fed expected to cut rate despite the growth. U.S. economy is strong, but there could be reason to lower borrowing cost. The U.S. Federal Reserve is widely expected to leave interest rate unchanged at the conclusion of its meeting on Wednesday, but investors will be watching closely for any hint at when and how much it might lower the rate this year. The expected rate cut raises a big question. Why would central bankers lower borrowing costs when the economy is experiencing surprisingly strong growth? The United States economy grew 3.1% last year, up from less than 1% in 2022, and faster than the average for the 5 years leading up to the pandemic. Consumer spending in December came in faster than expected, and while hiring had slowed, America still has an unemployment rate of just 3.7%, a historically low level. The data suggests that even though the Fed has raised interest rate to a range of 5.25%, the highest level in more than 2 decades, the increase has not been enough to slam the brakes on the economy. In fact, the growth remains faster than the pace that many forecasters think is sustainable in the longer run. Fed officials themselves projected in December that they would make 3 rate cuts this year as inflation steadily cooled, yet lowering interest rate against such a robust backdrop could take some explaining. Typically, the Fed tries to keep the economy running at an even keel, lowering rate to stoke borrowing and spending, and speed things up when growth is weak, and raising them to cool growth down to make sure that demand does not overheat and push inflation higher. Their goal right now is to keep the soft landing going. So, while risk tightening policy, now the challenge is balancing risk